Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. Let's get to some of the stories now we're following in the BNN Bloomberg newsroom. U.S. President Donald Trump is calling for de-escalation after Iranian and Israeli strikes on major energy sites across the Middle East. An attack on Qatar's Ras Laffan gas hub caused significant damage, while Israel struck Iran's key South Pars oil field. Trump says the U.S. was not involved in the Israeli strike and is warning Iran against further attacks on regional energy infrastructure. Eli Lilly says its experimental diabetes drug, retatrutide, delivered record weight loss in late-stage trials. Patients on the highest dose lost an average of 15.3% of body weight, outperforming existing treatments while also improving blood sugar levels. The results strengthen Lilly's position in the fast-growing obesity drug market, where it's competing with Novo Nordisk. The federal government is buying 30,000 rifles for the Canadian Army from Colt Canada in a deal worth more than $300 million. That covers the first 3 years of the contract, after which the federal government has the option of adding another 35,000 rifles. This contract is just the latest development in the federal government's defense spending spree. Taking a look at the markets today, it is another very off day for the TSX, down nearly 2% again. There was kind of a mid-morning where it recovered a little, but it has not. Materials, the hardest hit right now, it's off more than 6%. Energy, though, actually up 2%. And south of the border, things no better there. Sell right now. The S&P 500 off by 0.7, Dow Jones 0.84, and the NASDAQ by about the same. And taking a look at some of the trending leaders right now, the Vermilion is up more than nearly 14%. It is having a good day. Let's see what's driving. It's mostly just the energy. As I mentioned, the sector is up about 2%. Vermilion is one of those ones enjoying the ride. And this comes also earlier today, Scotiabank maintaining a sector perform on Vermilion. Another one we're keeping an eye on that's doing well, Methanex. It is up nearly 6.6%. And so it is being fueled on some good news as well. It's, again, the energies that are driving it right now. Same with BMO Capital yesterday, maintaining an outperform on Methanex. But you can see it's up almost 6.8% now, almost 6.9. Look at it going as we sit there and take a look. Cenovus Energy up for the same reasons. Now, Seabridge is going the other way. Seabridge Gold, no surprise. Metals are taking a hit today. Endeavour Silver, same thing. Seabridge up by 9.4, Endeavour 10.2, and G Mining Ventures almost 11.7% as the metals take a big hit today. Gold is dropping today. All right, Iran has intensified attacks on oil and natural gas facilities, raising the risk of long-term damage to key energy infrastructure in the Persian Gulf. While it's pushed oil higher, precious metals are, as we were just talking about, selling off, and expectations for a Fed rate cut are fading. Is there a method to all this madness? Let's bring in Tyler Morty, CEO and CIO of Four Strong Global. And Tyler, thanks very much for joining us. So let's ask that. Is there a method to the madness?
Roger, great to be with you. I mean, we live in a very fickle and strange world these days, of course, that goes without saying. But I think the method to the madness is that since the pandemic, we've had 4 major supply shocks. And, you know, the economy's had this sequence of supply shocks hitting the system probably every 12 to 18 months. If you look back, we had COVID, we had the Russia-Ukraine crisis, we had tariffs last year, and now Iran. And each time markets priced in, you know, worst case outcomes, and each time the global economy proved more resilient than expected. And so I think a useful thought exercise, and one we're certainly thinking about for our clients these days, is, you know, what is the market missing? We're obviously in a very emotional time. The headlines are very scary, and this is a serious crisis. But, you know, you look back to all those previous 3 supply shocks since 2020, since the pandemic, Roger, And there was always something that the market missed. And with COVID, it was we had this big or policy response with Russia and Ukraine. We learned that the energy supply chains around the world are pretty adept. And we saw oil rerouted to India, Turkey, China, that type of thing. And tariffs last year, I can think it goes without saying, but we had the president do his famous taco, and markets totally misread that as well. So our investment team is focused on that. The headlines are, as I said, obviously very scary, but we're focused on what the market could be missing right now.
Now, is this the same as 2022, the oil? I mean, we're now seeing places being bombed, facilities being bombed. Is this the same as 2022, or are we looking back more towards 73 with that massive oil shock then?
Yeah, I think a lot of people are trying to put an analog to 2022 or to the 1970s. I think with 2022 it was a little bit different because you were coming out of the pandemic and you had inflationary forces really surfacing, and so back then labor was very tight. Housing was doing very well and everything like that. So you had a stronger inflationary impulse. So that this time around we have a weaker inflationary impulse. Like before the Iran crisis, we had weak labor, we had weak energy, of course, and we had, at least in the United States, we had a housing market in recession, and so it's a different inflationary backdrop. Now, the 1970s playbook is, I think, Roger, is the one that everyone is going back to, and I think this is the one that matters. And of course, the instinct today is to think war, oil spike, inflation, recession. That, as I mentioned, that's a 1970s playbook. Now, I think investors are missing at least three things as it relates to the 1970s. The first is energy is far more diversified these days. In the 70s, OPEC controlled something like 50% of global supply. Today, it's closer to 30%. You look at the second thing would be that global trade flows are very highly adaptive, and we saw that with the Russia-Ukraine war. As I mentioned, it was sort of a real world test, and oil didn't disappear, just simply rerouted. And in this multipolar world that we have with lots of backdoor channels and that type of thing, without being too cynical, oil kind of found its way to the end customer. And then lastly, Roger, economies. This is the big difference for the 1970s. Economies are just far less energy intensive. In the 70s, the global economy consumed 3 times as much oil per unit of real GDP as it does today. The other thing is energy share. The energy share as a total of consumer spending is near historic lows. I mean, it's 3.7% in the United States as a share of total personal consumption. So, I mean, and, also the overall levels, like if you look at the inflation adjusted oil peak in 1975, it was about $245 a barrel. That's on WTI. If you look at the nominal peak back in 2008, which was $147 a barrel, that's about 222 in inflation adjusted terms. So I think the bottom line is that oil shocks do matter, but they just don't carry the same macroeconomic punch that they once did, particularly versus the 1970s.
And what kind of a factor then is the reports that we're getting that facilities are being damaged in that area? I saw with the Qatar, the natural gas, they were talking 3 to 5 years to rebuild that. What kind of an impact does that have?
Yeah, we're following that closely. I mean, I again, this is not to minimize what's going on. The war is serious, and it will impact risk premiums in the global energy markets. So what happened in Qatar yesterday with they're forecasting that 17% of the production will be damaged for the next 3 to 5 years. So there is some longer lasting damage. But I think the main point is that when the market gets really obsessed with a certain thing, and we go back to these supply shocks again, COVID was obviously a big thing, but the Russia-Ukraine war, tariffs were a very good example last year because the market just became super focused on tariffs are going to send us back to the 1930s. And of course, the macro backdrop is much larger than that. There's policy, there's earnings, there's cost of capital, there's all those types of things. So, us as a team at Forstrong are thinking that this is going to cause long-term higher oil prices, higher natural gas prices, et cetera, et cetera. But, we're focused on, does it short circuit the trends that we saw before the Iran crisis? And, to a larger extent, does it short circuit the cycle that we've seen that came out of COVID?
And I just want to sorry, yeah. Go ahead, finish your thought.
Yeah, just does it short circuit? Like we've had a cycle of higher fiscal deficits, corporate earnings that keep surprising, recession that sort of never materializes, and we've called this the high pressure economy, right? We're in a higher nominal growth and higher inflation period, and we don't think that the oil crisis, at least now, derails that at all.
All right, and I want to get to just quickly. We went a little long talking about everything that's unfolding right now. A couple of the ETFs that you're liking. Japan, the Franklin FTSE.
Yeah, so we're looking at, we've had this big sell-off. There's a lot of emotions in markets, so we're looking at what's sort of been indiscriminately sold off and what trends are going to be more durable after this crisis. Japan imports 100% of its oil. 90% of that comes through the Strait of Hormuz, so we know that's something that has been sold off aggressively. The Japanese story is great. It's under-owned in global portfolios. It's levered to a global recovery. This Franklin FTSE Japanese ETF has lots of industrials and lots of things that we like to see in what we've called the revenge of the real economy, this ongoing super cycle CapEx boom that we think accelerates with the Iran crisis.
All right, Europe, the iShares MSCI Europe Financials.
Yeah, we've held this one for a while, Roger. It's the European banking sector, just in short. And, again, looking back at the durable trends, Europe is in a classic cyclical recovery. We've seen wage growth go up. We've seen earnings go up. And this is coming off the back of like Europe, where nobody had anything good to say about it. So we think Europe as a major oil importer is one of those things that's been indiscriminately sold off. Will higher energy prices impact the entire region? Of course it will, but again, we don't think it's enough to derail some of these longer term trends. So this is kind of our shopping list right now as we look forward.
Okay, we got to wrap it up there, Tyler, but thanks very much for joining us today.
Thanks, Roger. Good to be with you.
Cheers. Tyler Morty is CEO and CIO of 4Strong Global. Coming up, Micron posted strong Q2 earnings and an even stronger outlook. Is Micron the new NVIDIA? We'll find out after this. Northwest Healthcare Properties has completed its name change to Vital Infrastructure Property Trust in what it calls an evolution into a focused healthcare infrastructure platform, and is now the only Canadian pure-play healthcare REIT. Earlier, we spoke with Zach Vaughn, CEO of Vital.
I think our rebrand is really a reflection of what our business is, which is a healthcare infrastructure investment platform. The services that are performed in our facilities, which are hospitals, outpatient buildings, surgery centers, imaging clinics, et cetera, are really critical to people's everyday lives. And so we felt like the name Vital really was a really kind of captured that, and then having the name infrastructure included made sense to us because our assets tend to be very long let. And the cash flows are supported by either highly rated government credit or private insurance credit. And we're also seeing an increase in the number of dedicated infrastructure capital that's looking in our sector. So we do kind of straddle the fence at Vital between and could attract capital from infrastructure or real estate investors.
And with that, are you worried about, with everything that's unfolding right now, worried about that capital disappearing?
Well, I think what's happening, you mean in terms of just, the market
the markets and the turmoil and yeah.
Yeah, I think in fact it could send more capital our way. I mean, if you look at what we do, these are, our assets are hospitals, they're outpatient clinics, surgery centers, et cetera. These are very non-discretionary in nature. You're not really there. You tend to not defer decisions to go, and so I think it could actually attract even more capital to our sector. We're certainly seeing more institutional capital looking to our sector, which historically was somewhat of a niche sector, and we're seeing those flows grow substantially. Obviously, we're just in a period of time of heightened volatility in the public markets, but I think the larger, more institutional investors are looking through that, and something like us is very well positioned.
And so it sounds like you're looking at more acquisitions. Where are you focusing? Any particular geographical or particular sector within health?
Yeah, so as we look forward, I think one of the challenges that we had, and quite frankly, one of the things that attracted me to the business was that although Vital owned assets in the right neighborhood, I think the business was misunderstood, partially as a result of its complexity operating all across the world in all kinds of different ownership structures. And so a really key goal we have is to simplify our business, not only by geography, but structurally. And so as we look forward, we're going to focus our growth here in North America. In Canada, in particular, it's a very exciting time. I mean, if you look at the demographic trends in Canada, in the next decade, about a quarter of the population is going to be over the age of 65, and we collectively, as Canadians, spend about $400 billion a year on our healthcare. And we do have in Canada, fortunately, some of the best large-scale, high-acuity hospitals, but that's not necessarily conducive to delivering general health care to an aging population. And so what we are seeing is hospital systems now increasingly moving from inpatient settings to outpatient settings. And these facilities are often smaller but highly specialized. And so delivering this next generation of healthcare infrastructure is a very meaningful growth path for us. For example, about 24 months ago, we delivered an ambulatory surgery center in partnership with Lakeridge Hospital in Pickering. It's about a 60,000 square foot building. So just in context, that's about the same floor area as a grocery store spread across 4 floors. It has 4 operating rooms, highly advanced. And as a system, Lakeridge has increased their surgical output by over 10,000 cases since they've opened the facility. Following that, in our quarterly results, we announced a commitment to build a $120 million facility with Royal Victoria Hospital in Barrie as well. So,
all right, I just want to jump in and talk about your international. If you're looking to refocus on Canada, North America, but you've got 133 properties around the world, what's the plans for them?
Yeah, I think we will over time. We've had assets in New Zealand. We've simplified our structure there, so we will likely exit that market. In Europe, we announced at the end of the year a transaction for 400 million euros to sell a substantial portion of our holdings there, as we plan to exit the region. So I think over time, you'll see us with a portfolio in Australia and in North America. But it obviously takes some time to make those changes.
And just from the financial side, just looking at one of the numbers, your monthly distribution, 3 cents per unit. Are you satisfied with that? Where do you see that going, and how do you see it changing?
Well, I think we're at a period right now where we're because of all the change going on and the repositioning of the portfolio, we're in a good spot with that. I think as we reposition and redeploy some of this capital towards North America, we'll start to see some more growth in that, and we'll obviously review our distribution, in time.
And that was Zach Vaughan, CEO of Vital Infrastructure Property. Up next, we'll get you the latest hot picks in the retail sector. Time for hot picks, and today we zeroed in on the retail sector. Our guest, Stephen Zaccone, senior analyst in equity research at Citi, had O'Reilly Automotive as his top pick. He points to steady growth with expansion ahead for the auto parts retailer. Have a listen.
consistency in the auto parts retail space, one of the best executors in all of retail, right? Auto parts retail is a great defensive subsector in the retail backdrop. It's a needs-based category, right? In the midst of kind of higher interest rates and consumer, tightening budgets, you're going to have to continue to repair your existing vehicles. So this business really serves that kind of sweet spot. And you think about the opportunity for market share gains, they've been the big market share gainer relative to some of the independents and some of the other players in the space. But O'Reilly's really best in class when it comes to the auto parts retail segment.
Is there any downside risk to your buy rating on this company?
Yeah, I mean, we're in the midst of a very macro tape, right? Like obviously, oil prices are up, right? What does that do to the consumer? We've published extensively here about, gas prices and the risk. Like we actually had a bunch of companies at our conference last week in Miami. We had 60 in total. O'Reilly was one of them. And, there's a lot of uncertainty, right? The key factors are, how long does the conflict last, right? We've seen this initial shock. We're really paying attention to what happens with consumer traffic trends and spending. So that is a risk if the consumer takes a leg down. But when you think about who are the more defensive businesses, auto parts is a relatively needs-based transaction. So I think they would be one that screens more defensively relative to some other discretionary purchases in retail.
Next hot pick is one I think a lot of people are familiar with, and that is Home Depot. What is it you like about this company right now?
Yeah, I think, if we start with the market backdrop, right? Like we've had a pullback in a lot of the housing exposed names within the last, month to 2 months. There was a lot of optimism coming into the year that we're going to start to see rates come down. I think you look at the opportunity here with the sell-off in this macro tape. This is your opportunity to lean into some of the better quality businesses that have a little bit more cyclical exposure. I put Home Depot right up there, right top of the list. You think about home improvement spending has a lot of pent up demand for the next couple of years. It's been very difficult to call the exact timing, but we've been in this period where, housing turnover has been weak. People have been delaying some of the spending on the home. As you start to see housing turnover improve at some point in the next couple of years, Home Depot is really the best way to play that in our view. You've got the exposure to the DIY customer. You've got the exposure to the large pro. They're doing some acquisitions to kind of build their capabilities. So, I think you're definitely kind of defending the weakness here in a Home Depot if you've got a longer term time horizon.
It's so interesting. Like I'm assuming some of the key risks for Home Depot, like for this company, is in correlation really with the housing market and how the housing market is doing in Canada. Is that right?
Yeah, I mean, U.S. more importantly, but yes, rates matter for housing turnover, right? And what matters, housing turnover really drives people doing large project activity, and that's kitchens, baths, flooring. That's the area of the market that's been, weak. We've seen engagement get better in the home, but you really need, the unlock of kind of turnover for some of that project activity to happen. So, I think great business in terms of protecting profitability. If sales come in a bit weaker, there's no real concern about margins being at risk at a business like this. It's just top line environment could be a little bit weaker, but I think that's a buying opportunity in the longer term view of the business.
For sure. Okay, your last pick is Tractor Supply Company. What is it you like about this one?
Tractor's a unique one, and it's topical in the sense of oil prices going higher. If you're looking for retailers that tend to be a beneficiary from higher inflation, Tractor hits that. They sell some oil-based products, right? So think about lubricants and stuff of that nature. They have some exposure they have higher exposure to the domestic regions in the United States where you'd see oil production pick up, and maybe that helps the local economy. So that's a Texas and an Oklahoma. The other factor is, they really have a dependence upon commodity inflation. So think about corn, grain, they sell a lot of livestock feed. Those are leading indicators for kind of inflation in their business. The fact that oil has gone up tends to be a leader for commodity inflation as it relates to their business. So they look like a net beneficiary. Now, I think they're still a second derivative housing play. So you'd like to see housing turnover improve. They have exposure to the pet category, which feels like we're at a point that trend should start to improve in 2026. The last couple of years, sales have been weaker, but I think it's a good quality business. They've got great control over the operating margin from here, and it's another one where this weakness is probably a buying opportunity.
It seems as though, the retail sector as a whole has been pretty resilient to tariffs over the last year or so, absorbing those costs as much as they can too. We're starting maybe to see a shift in terms of consumer spending, like consumer pullback in the retail sector as a whole. I wonder if that concerns you at all for the sector moving forward.
The tariffs, we've been able to pass on some of the pricing, right? Mm-hmm. And we're probably at peak in terms of tariff pricing, second half of 25, really now first half of 26. And largely speaking, we've been able to pass it on to the consumer. We haven't heard a lot of retailers have margin issues, right? I think the concern for retail and the consumer now, you have a prolonged conflict in Iran. Oil prices continue to stay high. What does that do to the health of the low-income consumer? What does it do to the propensity for, consumers to kind of spend on big ticket goods? It's a difficult environment right now, because if we get a resolution tomorrow and oil comes back down, it's a several week phenomenon that kind of goes away, and you start to see a recovery in terms of consumer confidence. But if it lasts longer, it is something to monitor for the health of the consumer.
And that was Steven Zaccone, Senior Analyst in Equity Research at Citi. Coming up, energy prices are impacting markets, including small businesses. We'll talk to our next guest on that impact after the break. U.S. President Donald Trump is calling for de-escalation after Iranian and Israeli strikes on major energy sites across the Middle East. An attack on Qatar's Ras Laffan gas hub caused significant damage, while Israel struck Iran's key South Pars oil field. Trump says the U.S. was not involved in the Israeli strike and warned Iran against any further attacks on regional energy infrastructure. Shares of Auto Canada are plummeting after swinging to a fourth quarter loss on lower revenue. The Edmonton-based multi-location North American automobile dealership group says its fourth quarter performance was shaped by a more challenging market backdrop. Demand was affected by activity like the sunset of the Canadian EV tax credits that benefited the fourth quarter of 24 and tariff-related policy changes that drove stronger demand in the first half of last year. Meta is shutting down the metaverse. The company says its Horizon World social VR platform will be removed from Quest headsets on June 15th. The app that sat at the center of Mark Zuckerberg's metaverse plan will disappear from the Quest store at the end of March. In January, Meta cut roughly 1,500 employees from its Reality Labs division, signaling a shift away from VR technology. And looking at the markets, it is another off day for the TSX, down now 1.86, and it is struggling today and below 32,000, and south of the border, not much better. Not really much to tell you about that make you smile. Everything is in the red right now. S&P 500 off by 0.75 of a point. The Dow and the NASDAQ off by about 0.86, 0.88. Well, small business confidence in Canada is taking a sharp hit as rising fuel costs and persistent demand weakness weigh heavily on outlooks. Here to give some in-depth analysis on the issue is Andrea Bourgeois, Director of Economics for the CFIB. Andrea, thank you very much for joining us.
Thank you for having me.
What is the biggest concern right now for small businesses?
Well, first of all, their optimism plummeted in March. It's something that we've been monitoring for years, so it's not just, it just happened, it's a bad month. So that is very, very concerned. They don't have these composite indexes and all this optimism for them. It's about, if I feel good, I feel strong about my business, I'm going to invest in my people, I'm going to have new products, new services, and I'm just going to expand. I'm not optimistic. I'm not going to do any of those things. And then those things, they reflect in, macroeconomic indices. The first thing that is way on their mind is fuel costs. We have seen this indicator increasing sharply in the month of March. Has it Is it at the top? It can be, probably not. But it's one of those costs that affects every industry and every type of business.
And that may only get worse. How concerning is it that we may not have hit bottom yet with that?
It is very concerning. Right now, this indicator stands at 50% of concern, which is one of the highest levels ever. And if this goes up, it will trigger impacts on supply chain. The other indicator that has risen sharply in March was input product costs. Small and medium-sized businesses, most of them are local, but it doesn't mean that everything that goes into production is local. They still depend on imports. They still depend on, products and raw materials coming from somewhere else. So fuel costs are number one on their horizon. So these two costs were really making a huge impact on their optimism level.
And with that confidence index, what's the worst it's ever been, and when was that?
Oh, that's a very good question. The worst it has been easy to answer. It was actually March of last year. So unfortunately, the fear of tariff was so strong that optimism plummeted at the lowest level ever, 25, in fact. And, just a parenthesis, an index basically goes from 0 to 100. It would be 100 if everyone would be optimistic. The highest we have seen it was in the high 60s when the economy was growing. That is back, before the 2015. So that's quite a while since. It has been a bit challenging, obviously, since the pandemic. It has dropped around, the 30 point during the pandemic, and then the tariffs made it go even lower than that. And it was the long-term optimism that was affected the most, exactly a year ago. It has been gradually increasing. And actually last month, it would have been a really positive discussion about it because small businesses have seen a glimmer of hope. And then it was too soon to speak about optimism long term because this month has proven to be very challenging and it took a turn towards the worst. It's still above the 50 point. And I say the 50 point in the sense that everything below 50, in fact, we should talk about pessimism. Everything above, it's very modest optimism, but is not showing that the economy is or can be growing at its potential.
And I guess, and you mentioned off the top about the people hesitating to do anything right now. And the danger, I guess, of that is even when things do start to turn around, will it take a while for them to get started on things, or will they be trying to play catch up then as well?
Absolutely. We're seeing very slow adjustments. For example, one of the indicators we're watching is employment changes. Everyone watches that. But small businesses are particularly busy during the summer, in Canada and in a lot of other states. And that indicator, usually we see a pickup this time of the year. Well, it's very modest for March. It has, the chance of increasing later on. But this is where you see that if they're not looking to increase their labor force for the next coming months, they probably don't expect a stellar summer. Therefore, fewer services, fewer products, shorter opening hours. So in other words, they actually expect lower revenues for their months to come.
And finally, I guess it's a positive. Are there any sectors that are benefiting from this situation or taking advantage of the situation?
The sectoral picture is usually a bit more mixed. Some sectors are doing better than others, and I think it's normal. The sectors that are usually dealing mostly in services and would rather serve, customers instead of other businesses, they tend to be still on the optimistic side. If you think of the health sector and everything related to that, some of the other sectors, professional services, those are a little bit more sheltered, from fuel cost, input cost. But it doesn't mean that they're doing great. And, the economy cannot grow even despite two sectors being very optimistic. Where we see at the other end of the spectrum is construction being affected, manufacturing, transportation, agriculture, those sectors that depend on fuel costs, that depend on input products.
And how are they doing right now in comparison?
They're rather pessimistic. They're not that they're rock bottom, but they're not really in an optimistic position. They're not in an expansion thinking. You see their business owners being more cautious about the future and just, if you're not planning for higher revenues, you're not going to plan on higher expenditures either.
Okay, Andrea, thank you very much for joining us today. We appreciate it.
Thank you for having me.
Andrea Bourgeois is the Director of Economics for the CFIB. A fight in hockey. That's not that unusual, but how about over a puck? The U.S. wants it back. but it's in the Hockey Hall of Fame in Canada. Uh-oh. We'll have more after the break.
By lies of fast cash.
What did you think was in the bag?
Trapping young Canadians.
She's a 19-year-old girl.
As unsuspecting drug mules.
People pay a lot of money for cocaine.
W5 goes deep inside Hong Kong.
There are 4 Canadians in prison right now.
To uncover a crime syndicate.
She wants us to expose these people.
Hunting for traffickers.
They just asked me to find people for them?
Here at home, W5's Avery Haynes investigates. Saturday at 7 on CTV and Crave.
Well, Jack Hughes scored the golden goal for the U.S. at the Winter Olympic men's hockey, but the puck is in the Hockey Hall of Fame in Toronto. He wants it back, and it is sparking another cross-border dispute. Do we really need one more of those? Bloomberg's Ari Alstetter joins us now to talk a little bit more about this. And Ari, give us a little setup for what unfolded. Thanks for joining us, and give us a little setup. What's happened, and why is Jack so mad?
Well, essentially, it came out in some interviews Jack Hughes did in the last few weeks that he didn't know where the golden goal puck was and that he actually would like it back. Eventually, it came out that the golden goal puck was currently on display at the Hockey Hall of Fame in Toronto. So when ESPN asked Jack Hughes about that a few nights ago, he expressed anger at that he should be the one to have the puck, that he was actually trying to get it back, and he didn't know why it had gotten to the Hockey Hall of Fame in the first place. Those comments kicked up a bit of a brouhaha online. They got a lot of attention. They sparked a lot of discussion in forums like Reddit about whether he had a right to want the golden goal puck, which is the kind of thing that the NHL often allows players to have, those kind of memorabilia from games, or whether it was better off being displayed at the Hockey Hall of Fame for the public to see and enjoy, which has sort of been the tradition for memorabilia used in Olympic hockey and international tournament hockey. This kind of debate raged until, last night actually, Hughes was asked about it after the game as well, and he seemed to concede that he probably wasn't getting the puck back and that perhaps the Hockey Hall of Fame might be an okay place for it.
An okay place. It's awesome to go there. I guess it's a question of who legally owns it, right? I mean, does the International Ice Hockey Federation own the puck? And if somebody does score a goal, they can say, okay, you can keep the puck? Or is it up for grabs? Is it fair game?
No, the International Ice Hockey Federation is, the owner, the custodian, if you'd like, of this kind of shared kit that's used in international hockey tournaments. They help administer these tournaments, including the Olympics. And so traditionally, since I believe 1998, which was probably the Nagano Games, the International Ice Hockey Federation has turned over significant memorabilia like big golden goal pucks to the Hockey Hall of Fame. This has been a long-standing tradition of donation between those two sort of institutions. But of course, as I said earlier, that kind of runs counter to what the NHL usually does and what Jack Hughes is probably used to in NHL games and other games in his career, where if you score an important goal, maybe you get the puck. That's not the same tradition in international tournament hockey, and that seems to be where the kind of tension came up about this issue.
All right, well, he seems to have chilled a little. All right, thank you for that update. We appreciate it. Bloomberg's Ari Alstetter. Now, apparently Jack Hughes wanted to give it to his dad. Still ahead, today's Market Movers with Bloomberg's Matthew Griffin. Time to take a look at some movers south of the border. We're joined now by Bloomberg equities reporter Matthew Griffin. Matthew, thanks as always for joining us. Okay, Micron had been on fire until, finish that sentence.
Well, Roger, thanks for having me. And Micron had been on fire until the company today gave an outlook for this year's capital expenditures above what Wall Street was looking for. The company expects to spend $25 billion this year. Analysts expected a little over $22 billion. And in some ways, Micron has a good problem. There is booming demand from artificial intelligence companies for the memory semiconductors that they make. You need that data storage in order to train and run AI models. That is flowing through to their revenue, to their profit. It's pushed the shares up about 340% over the last 12 months. However, something that we've seen in recent weeks, recent months, is investors getting a little bit more discerning about how much money it takes to, for example, in Micron's case, boost production to meet that demand. Is the payoff going to be there from all of this AI-related investment companies are making? And that's bringing the shares down today about 3.5% as we're talking.
And I mean, that really is the trend right now, isn't it? They deliver pretty much perfect reports, or not perfect, but pretty good, and nobody's happy. It's a jinx now.
Yes, and I would say the expectations were just sky high coming into this report. So it's not that the balloon has popped here. Again, you look at where the shares traded versus a year ago, just that a little bit maybe of concern creeping in today. Shares down actually as much as 8.8% earlier.
All right, and FedEx, when it's just got to get there, may not be able to get it there.
Yes, FedEx shares inching lower, down about 0.5% before their earnings due out after the closing bell today. Now, that price action today probably less to do with the report than what's going on in the Middle East, rising oil prices, fears of a hit to the economy. That being said, the news in the Middle East, exactly what investors are going to have in mind when FedEx reports and when they take analysts' questions. This is a company deeply tied into the U.S. economy and the global economy. I mean, their business is shipping goods, and investors are going to be listening in, are they seeing businesses, seeing consumers pull back on the demand for good shipments as they, for example, spend more money on gasoline. That's going to have implications for FedEx. Also probably going to help set the tone for this market, which is trying to game out the implications of the war.
All right, and the last one here, Five Below. I had to look up what this is. It's a specialty value retailer. It sells phone cases, LED lights, all the quirky stuff that people love.
Yes, pop culture branded toys, that kind of thing. And today, investors really happy with the outlook the company gave. Shares up as much as 12%, trading at levels not seen since 2021. The company gave a better than expected profit forecast. They expect comparable sales growth of 14% to 16% this quarter. That's versus estimates of just above 6%. Now, you and I talk a lot about this idea of how is the consumer holding up, the K-shaped economy, who is still spending money, what are they spending it on? And this is an interesting company. They're a discretionary company. That's usually where people cut spending. At the same time, they are a value retailer. And what Bloomberg Intelligence says is there could be a sort of flight to value with consumers under pressure that could actually accelerate as gas prices rise, as inflation maybe picks up due to the war in Iran. And above and beyond these results, all of that could end up flowing to companies like this in terms of consumers directing their spending there.
And I guess it's a case of, is it a discretionary or which one is more of it? And I guess we'll see how is it more discretionary or is it more value? I'm putting you on the spot.
So it's, it's sort of both at the same time in that it's goods you don't necessarily, that aren't essentials, but that you might buy at Five Below instead of another company if you still want to buy them. You want that branded phone case, but you don't want to spend to get it at a premium store. That said, this year it is trading certainly like a company oriented toward value consumer. Shares up about 25%, and that comes as we've seen consumer staples companies, the Dollar Trees of the world, for example, outperforming.
All right, I guess Easter will be the test for it. Okay, Matthew, always a pleasure, sir. Thanks for joining us.
Thanks for having me.
Bloomberg's Matthew Griffin. And that wraps up this edition of Trading Day. I'm Roger Peterson. Have yourself a great day.